Welcome to West End Advisory Group's webinar on pre-retirement. I'm Lori L. Frank with Client Services. At West End Advisory Group, we use a plan-first approach to investing because we believe knowing how much money you need and when you will need it are the most important factors in your investment success. This webinar is intended for anyone nearing retirement age and is part of our quarterly financial literacy webinar series. Today, we'll discuss subjects such as creating a budget, taxation of Social Security, as well as key dates and ages for Social Security, Medicare, and much more. Today's webinar is being recorded and will be available for viewing on our website. During the presentation, when you have a question, please use the raise hand symbol in your webinar controls and we will unmute you. Our first speaker today is Joe Rohde. Joe is a certified financial planner and has been in the finance industry for over 40 years. He started West End Advisory Group here in the Central West End and offers securities and advisory services through LPL Financial. LPL is one of the leading financial services companies and the largest independent broker-dealer in the nation, representing more than 16,000 independent financial professionals across the country. We'll also be hearing today from Steve Mayer. He is a St. Louis native and is also a certified financial planner with LPL. Steve has been a financial advisor for 11 years and joined West End Advisory Group in 2019. Now I'll turn it over to Joe.
Thanks, Lori, and thanks everyone for joining us this evening. We're going to try to keep this down to an hour. Before we turn it over to Steve, let's go over a couple kind of basics. This is our agenda for tonight, where to start. Steve will conduct that. Income and expenses, I'll cover that. We're going to try to make it interesting by switching between the two of us. Steve will cover Social Security. And then our number 4 category, our 4th item is how much money will you need in retirement? And then, as Laurie said, we're affiliated with LPL, which is one of the largest broker-dealers in the world with over 16,000 investment professionals. They're the ones who actually researched and developed this seminar for us this evening. And while we like LPL and all the things they do, we sent out several exhibits, and one of them is not necessarily the best thing. We're supposed to wrap it up by walking you through and actually helping you calculate how much you'll need in retirement. And Laurie had sent out with the confirmation these exhibits. One of them, this one here called Preparing for Retirement, you won't necessarily need that, but it follows roughly what the slideshow is. We will be emailing out the slides and a copy of this probably tomorrow or the next day. Later this week, we'll be emailing that out to you. This is a fairly useful tool. The second exhibit that was sent out is the math problem that they think that we're supposed to solve over the internet, which is just, I think, kind of a waste of everybody's time. It does have some good information on it, though. On the first page, they have critical dates. Age 50 is when you can start making catch-up contributions in retirement plans. Age 59 and a half, that's when you can pull money out of your IRAs without penalties. Age 62, that's the age at which you can first begin taking Social Security. Age 65 is your Medicare date, where your age of being able to qualify for Medicare. Age 66 or 67 is when you can receive your full Social Security. And then age 73 is the age now for when you have to begin taking your required minimum distributions. There's some useful information in this, but it is not something that's very conducive as far as calculating your retirement. We will, instead of doing that, we'll cover a couple tools that we use or that are available readily that will, we think will be more advantageous and more, frankly, practical to use. So with that background as far as what the exhibits are, let me go ahead and get started by turning this over to Steve, who's going to talk about where to start at in the retirement planning process, which is talking about goals. Steve?
Thank you, Joe. Yeah, so let's go ahead and get started talking about where to start. And Joe, if you can just take me to the next slide there. So you have to start really when you're setting goals on long-term financial needs. You have to, one of the big places to start is just to know what you need to spend. So you start with a budget. And you have to really begin before knowing what your budget is going to be by answering these questions of where will I live? What will I do? How much money will I need? How much money do I have? And what are likely health related issues that you might run into? So I'm sure you've thought of several others that are more specific to you. And we recommend starting a file as kind of an organizer to keep those retirement related questions together, track any answers that you have and any other information that you collect that will be helpful, in any future meetings. So when it comes to the budget, skip to the next slide there. And budget's a little bit of a loaded term. We do like to think of it as a spending plan. It basically is really a spending plan. It takes into account all of the income you expect to receive. It should identify specific expenses that you'll face and tell you how much you'll need and able to be able to meet each of those expenses. By creating the spending goal, you'll find that almost naturally by going through that process, you'll set some limits on expense items. And for example, let's say if you are going through that process and you find out that over the last few months you've spent several $100s going out to movies, maybe with friends or families. But without a budget, you wouldn't have much of an idea how much you were spending on the movies. But just by tracking it and paying attention to it, you might find out that you could have gotten the same enjoyment by maybe buying a big screen TV or renting movies 6 times a month instead. And you end up saving some money over the long term and enjoying it a little bit more. And that's really what we're looking to get out of this spending plan is getting more out of your money. So what we find is our clients have really given us feedback that rather than feeling constrained by going through that process of creating a budget, they end up feeling like they're achieving more of their financial goals. It results in savings lasting longer, and it gives them really just more of that feeling of control and financial security. So it's hard to argue against the value of having a budget, but let's go into a little bit more of the reasons behind having it. Some of the specific advantages of a retirement budget include, these reasons right here. Control we just touched on, but a spending plan will empower you to take control of your finances. You'll have the tools and information to decide exactly where your retirement money is going to go. So instead of having it limit you, you're really in charge of the money. And at its most basic, a spending plan divides income and expenses into useful categories, but it, in addition, will provide further organization. So if you have an idea of exactly what category the money is going into, it'll automatically keep a record of all those transactions and help you come tax time for a simple filing system. It'll help to organize bills, receipts, and bank statements. You'll just have a lot more knowledge about your situation and know exactly where you stand financially. You'll be in control of the money, and it might allow you to take advantage of opportunities that could come up in which you otherwise would maybe miss because you wouldn't know whether or not you'd have the money to be able to afford to do that thing. With a budget and a set spending plan, you'll know. So when your spending plan is operating, all of your financial transactions should automatically be organized in that way. So come tax time, instead of scurrying around, digging through the old bags and shoe boxes to find the necessary records, you can actually save a lot of time by just having it already ready to go. So best of all, the top reason for having a budget that we hear is that often people just end up producing extra money out of it. Unnecessary expenses get cut out once you've identified them, and savings, even small ones, accumulate. And with a spending plan, you can put those savings to work for you in retirement. It's a very important thing once you're retired. So it's no secret that in order to have a budget, you need to be really specific about your income and expenses. And Joe's going to talk a little bit now about how we can categorize those different types of income expenses.
Thank you, Steve. Income and expenses. Bunch of different ways of categorizing your expenses. Can't tell you enough about a budget and tracking expenses, how meaningful that is. It's something that I started doing many years ago, and it's made a real difference in my life. It helped me make value decisions over how I was spending my money and what was really important. To do that, it's really important to track what those expenses are. Some of your expenses are going to be fixed and they're relatively easy to track. They're happening every month and you know about it. Others are more variable and they're going to pop up throughout the year and you're going to lose track of them. One thing that we realize, probably the most common problem we run into when we first begin visiting with clients is having them have an idea of how much money they're going to need in retirement. And that's really something we can't answer for them. What I can tell you is almost universally, everybody underestimates how much they're spending. And it's very easy to go ahead and make a mistake on calculating it. There are a number of things that make it more complicated. First off is the timing of, for example, taxes. You pay your taxes every time you get paid, they pull it out. But then at the end of the year, you either end up owing more money or else you get money back. And it's kind of difficult. That doesn't necessarily show up in your budget. Likewise, if you are borrowing more money, if you take out a loan throughout the year, you've probably spent more money than you made that year. The flip side of that is if you are paying off loans, you're actually saving money. So when you're thinking about retirement, trying to track and really get an accurate count on that is very important. There are several tools that are available that for those who are really serious about this. Quicken is a tool that I've used. Steve, what did you use? You used Mint in the past, is that correct?
That's right. I used to use Mint. There's a lot of categorizing transactions in there, but once you get it down, then it runs on autopilot and you can just check it every once in a while and see what you've spent over the last month or year.
So the other thing that's happening in the financial industry is, the credit cards are getting much better at tracking your expenses for you. I remember it used to be you'd have to go through and put them all into categories. Now a lot of that's happening automatically. And many of the credit card companies will provide a year-end statement that will have all of your expenses categorized. Another big tip we give for folks as far as tracking their expenses is to make sure that they have their personal checking and expenses all paid from one account. Now, if you're married and you have two accounts and you don't want to get to the point where you're having a divorce over this stuff, everybody has, every married couple, it seems, has their own way of dealing with money, but it really will make your life far less complicated if you're paying all of your bills out of one checking account. And this is particularly true for people who have small businesses that they're running. And it's not unusual to start a small business on your own and you have your personal and your business expenses all kind of lumped together. As soon as you can go ahead and get those separated, it will make your life far more simplified. And the same thing if you own a piece of rental real estate or anything like that, it really can make a big difference by having a separate checking account for each business entity you're doing, every separate thing you're doing like that, keeping it separate and paying all of your personal expenses out of one checking account. When we start talking about the fixed expenses, these are ones that are occurring on a regular basis, whether they're your taxes or so forth. We'll kind of go through and talk a little bit about how these things can confuse you on how they're paying. We can start with taxes. It used to be, we used to try to categorize how we were spending things on whether or not they're tax deductible or not. Starting several years ago, when one of the Tax Act that President Trump enacted, he dramatically increased the amount of the standard deduction. And for those old timers like myself, we used to track how much we paid for mortgage interest. We used to track how much paid in state taxes and real estate taxes, how much we gave to charity and spent on medical bills. And all of those things we would add up and then itemize them. Beginning about, I guess it's been about 4 or 5 years ago, they stopped that. You still could itemize, but very, very few people would qualify for itemizing. The standard deduction started out at $24,000, and what's it up to now? I think it's $27,000. Is that right, Steve? Anyway, it's mid-20s, and there's just not that many people who itemize anymore. So keeping track of your tax deductible items isn't as important as it used to be. Although that may change, because in 2026, the Trump tax laws go away and we revert back to how things used to be. So, but we have, that's 2 years away. With taxes the way they are and the budget and everything, things can change radically. But for right now, we're scheduled to go back. How did we get to variable expenses? Let me go back. So that's taxes, mortgage and rent. That's one of the confusing things that we talked about earlier. When you're paying your mortgage, you're actually, a portion of it, of course, is rent, but a portion of it is savings. When that mortgage is paid off, that drops the bottom line. On the other hand, if you're renting, that rent will continue and probably grow in the future. You have utilities, which are expenses, of course, your insurance, automobiles, all of those things. Well, automobiles, if you have a loan against your car and you're paying it off, you're in essence saving. And if you're fortunate enough to buy a new car and you can pay cash for it, then that's going to be one of those one-off expenses. Most of these other expenses here you can see are things that are a little bit more in control, or they may happen once a year, and they're very, very easy to miss if you're trying to figure out how much you're spending in a given year. There's a couple tips on this. Is going through assuming you have your one checking account, going through that at the end of the year and trying to pick out and categorize things. That's, as Steve was saying when we were doing the budget, very, very important to do. And when you begin collecting all of those things, then we know we have a full picture and you can feel a lot more comfortable. Getting ready to retire and estimating your expenses is something you want to go ahead and measure twice and cut once, because you don't want to get retired and realize that you're spending a lot more money than what you would otherwise. Now, when we get over on the income side of the budget, we said it wasn't that important right now to track tax issues for your expenses. Quite the contrary on the income side. On the income side, your wages and salary, what happens in the government, it is just mind-boggling how confusing they make their taxes in this country. Wages and salary are taxed as ordinary income. Therein is effect multiple different tax brackets going on all at the same time, and each of these incomes are getting dropped into different baskets of taxable income and into these different brackets. Wages and salary are subject to both income tax and payroll tax. So when you make $1, you're paying not only income tax on it, but you are also paying payroll tax. When you talk about income from self-employment, so that would be Schedule C income. So if anyone out there is self-employed, you will end up paying not only your regular FICA or Social Security tax, which is 7.65. That's what your employer deducts from your salary, but you actually have to pay that twice because you're self-employed. So you're paying over 15% payroll taxes if you're self-employed, And then of course you pay income tax on top of that. Both self-employment income and wages are subject to the ordinary income tax brackets. Most pensions and IRA distributions are also subject to ordinary income tax. That's the tax brackets most of us think of, ordinary income. However, you will not pay any FICA or payroll taxes on pensions and IRAs. When we talk about interest, when you have your money invested in a CD and it pays interest, that interest is ordinary income. However, if you invest in a mutual fund and that mutual fund pays dividends, those dividends are considered a tax preference item, and most of the dividends come out at a much lower tax rate, which is capital gains tax rate. And again, that is a completely separate bracket. And then finally, if that's not confusing enough, when you retire, you receive Social Security, and Social Security is sometimes, for some people, depending on your income level, can be completely income tax free, or sometimes it's taxed at 50%, or sometimes at 85%. When we say tax, we don't mean you're paying 85% tax on Social Security. We're saying that 85% of the Social Security income is subject to tax. So it's very important to categorize those. For Steve and I, we're kind of these financial planning nerds. We have some great software that when we plug into, it's relatively new, it's called Holistiplan. When you plug in the tax returns, it actually divides things up and it creates a much clearer picture of which tax brackets you're paying. They will clearly show you how much of your Social Security is subject to tax. They'll show you how much your ordinary income tax brackets are, your capital gains tax brackets, and you even, if your income goes higher, you can end up paying higher Medicare taxes, and this program breaks all that out for you. It's really a neat program. Don't have time to go through it today and stay on schedule, but that is a very, very powerful tool for when it comes time to retire and figure out where what things you're going to be paying your taxes on. So now we're starting to get down to where the rubber meets the road. If you're working, we hope that your income is higher than your expenses, and that gap is what you have available then. That surplus is what you have available to save for retirement. And of course, in retirement, we generally expect that your income from Social Security is probably not going to meet all your expenses, and that's going to result in a gap. And that gap is what we're going to have to cover from income off of your investments. And knowing how much that gap is and what year or what months that gap occurs in contributes or really kind of feeds into how we invest your money. In years where there's small gaps, we don't need to have as much liquidity, and we can be more patient with the money. In years where there's big gaps, we have to plan for that. Over the long term, let's use an example. Very simple example. Let's say that your monthly expenses are $5,000 and that your Social Security is going to be $3,000 a month. So you have a $2,000 a month gap. You're going to need investable assets of about 20 to 25 times that amount. So if you are talking about a $2,000 a month gap, that's $48,000. 20 times, $24,000. 20 times that is $480,000. And that would give you a 5% distribution rate, and you would hope that would end up being able to grow with inflation. If you wanted to be a little bit more conservative, you might want a 4% distribution rate, in which case you'd need 25 times that $24,000. And so then how do we go ahead and start figuring out what's available to generate that income? Well, we're going to want to go ahead and develop a personal financial statement or a balance sheet for you're going to want to do this so that you have an idea. Typically, your assets are going to be divided upon investment assets and personal assets. On the investment assets, that might be cash, bonds, stocks, mutual funds. All of those things can generate income and are available for you to cover that gap. On the other hand, your home, car, truck, boat, any furnishings, antiques, jewelry, all those are assets and might be worth something. They're not going to be available for you to, they're not going to be generating income to cover that gap. So we're going to want to break your assets down into personal assets and investment assets. And then we're also going to want to go ahead and understand what your liabilities are. And your typical liabilities that you might have would be your mortgage, if you borrowed money to buy a car, any other loans, credit card debt, if you have large tax bill due, major unpaid bills. And you're going to want to know when those liabilities are due and how much they are. Again, this is all tied to the developing an investment plan based on when the money is needed. When you get all your assets lined up and figured out, then you subtract your liabilities, and that gives you your net worth or your personal net worth statement. And why might you want to calculate that? We run into that frequently. People, perhaps in retirement, some people may want to downsize and sell a big house and move into a smaller house. Other people decide that they want to buy a second house. But if you're going to go in and apply for a loan, the bank's going to want to demonstrate that you can pay it back, and they're going to want to have a balance sheet. Another great reason for collecting that information and getting it all organized in one spot is when the time comes to prepare your will. We frequently, as we're working with people, it's a point in their life where a lot of times they come in and they haven't thought about their estate plan, and now they're retired, they have time, and they begin thinking about it. And having your estate plan organized and knowing where your assets are is going to be very, very helpful for either your spouse or your children. And then, if you need insurance, it can help you determine that. And it's a great thing to have. My wife and I, gosh, we started many years ago doing this. And every year I would end up doing the update my net worth and take it home, and we'd have good years and we'd kind of celebrate, and bad years we'd think, well, we'll have to work a little harder next year. But it was a great thing to see, having done that for 20 or 30 years, to see how that's grown, and it's provided us a lot of satisfaction and frankly a lot of confidence and security as we approach retirement age. So now Steve and I have been talking now for about 20 minutes. Pause if there's any questions now. Somebody wants to raise their hand, that we'd be glad to answer them, or else we'll roll right into Social Security.
Yeah, let me just remind everyone, if you have a question, you need to click on the raise hand symbol in your webinar controls. If you're on a desktop, you would move your mouse across the bottom of the screen and you'll see your webinar controls, and just click on that hand symbol.
Okay. I don't see any questions being answered. Ask Steve, why don't you go ahead and take over now, Social Security?
Okay, sure. So let's go ahead and dive into some of the basics about Social Security here at first. The big question that we get asked when a client comes in and wants to talk about Social Security is when to file, when to start receiving those payments. And you can begin receiving Social Security benefits anytime between age 62 and age 70. Beyond age 70, there's no benefit to wait. So how much what your age is, your full retirement age at which you'll receive 100% of your benefit, depends on the year in which you're born. And that's what this table sums up here. So for example, if you're born in 1948, then age 66 is your full retirement age. That's the age at which you'd receive 100% of your benefit. Someone born in 1960 or later has to wait until age 67 to receive 100% of their benefit. So if we can, let's take a look at how receiving benefits early can impact the amount that you receive. And, so starting your benefits early again would be starting anytime between age 62 and your full retirement age. The reduction that you're going to have from starting early will range anywhere from 20 to 30%. So let's say from the table there that you were born in 1950 and you qualify for a monthly benefit of $1,000 at your full retirement age, which is 66 in that case. But you want to start collecting payments as soon as you can. So at age 62, you turn it on. Well, then you'll receive a 25% reduction. So you'll get 750 instead of that 1,000. And that reduction then is going to be reduced for each year that you wait. So each year that you get closer to the full retirement age. So if instead you started receiving those payments at age 63, then there's just a 20% reduction. Age 64, then there is about a 13% reduction. And then age 65, you have a reduction of about 7%. So anyone who needs income right away, you certainly can take those benefits early, but it's appealing, but it's a permanent reduction in the benefit. So it's a really big decision. Now, on the other hand, if you wait until after your full retirement age to begin receiving those payments, then you can actually have a bump up in how much of a benefit you'll receive. I think everyone on the call has been born after 1943. So for anyone born after 43, you're going to get an 8% per year increase in your benefit for each year that you wait after your full retirement age. So again, that's 8% a year up to age 70. For every year that you wait up to age 70. After age 70, there's no more increase. So you'll need to start taking it there at that time. And remember that if you work past your full retirement age, and then you have more earnings coming in, well, that's going to change the calculation of your benefit too. Social Security uses the highest 35 years of earnings. So any additional year that you're putting in a new higher figure, higher than any of those other 35 years or a year in which you didn't work, then you're going to get that increase in your benefit along with that 8% increase. So they will be combined to get you a bigger benefit. So those are the big, easy timing questions of when to take your Social Security benefit. But the other big variable there that you have to consider, of course, is how long you expect to live. Every year, of course, that you're waiting for that higher payment, of course, you want more years of those payments at the higher rate to make up for that time that you'd waited. So typically that break-even point ends up being somewhere in the early mid-80s. So that's a big consideration and a big unknown, but it's going to be different for each person there. So then the next big question that we hear is, how is Social Security taxed? And that's what this table breaks down here. So yes, Social Security benefit will be subject to federal income tax if your combined income is above these certain limits here. So combined income for this purpose, as defined by SSA, is your adjusted gross income plus any non-taxable interest that you receive throughout the year, plus half of your Social Security benefits. So for example, just looking at the table, if you were a single person with $30,000 of income in the year, combined income in the year, then 50% of your Social Security benefit would be taxable. If you're filing jointly and you have 40,000 of income, combined income, same thing, 50% of that benefit from your Social Security will be taxable. So keep in mind also that your total income there at AGI, it includes employment income, dividends, capital gains, and so on.
Steve, if I could, I'd like to make one comment. One of the things that is deceptive about this is the definition of income that they use for this. It's very unique. It's called combined income, and we work with cases, and it's just amazing. if you have a couple who are high earners who work to 70, they could have $100,000 of Social Security income. And if that was the only income they had, they would pay zero in taxes, which is hard to believe. On the other hand, we've had couples who come in and they could probably make $50,000 or $60,000 a year and pay no taxes so much of it is dependent upon where their income is coming from. On the other hand, if somebody comes in with a relatively small amount of Social Security and they have a large pension, they could end up paying much more in taxes than somebody who's making far more money. It's a very complicated calculation, and it's worth taking a look at and making sure you understand that. So, sorry to interrupt. Just wanted to hop.
No, yeah, that's a great point. And you can't stress that enough. This is a pretty permanent decision that you make here. So very important that you get it right. If you think of it in terms of if this were an asset, not just an income stream, if you came to us and wanted to buy an annuity that would give you this kind of guaranteed lifetime income, you're typically talking about 7 figures or so to replicate what you're getting with Social Security. So very important that you put some time into making that decision. So that's the tax part. And then there's also an earnings limit that I wanted to talk about. And that is, it functions a little bit like a penalty in a way, but you can receive your benefits while you're working. There is, however, a limit to how much you can earn before your benefits reduced. So for 2023, that's the limit, $21,240. That's adjusted annually with inflation. And this limit only applies up to full retirement age, and then it goes away entirely. So, for example, if somebody's 62 years old, they start receiving their Social Security benefits, but they still work. In their full retirement age, say at 66. Well, if they earn then $22,240, well, that's $1,000 over that earnings limit. And what happens is they reduce then your Social Security benefit by $1 for every $2 that you earned over that limit. So that person that received $22,240 would receive a $500 reduction in their Social Security benefit. So there's a much higher limit once you get up to the year in which you hit your full retirement age. In that year that right now, the limit's more than double that. It's 56,000 plus. And also that reduction calculation changes. It goes from $1 reduction for every $2 you earn to $1 reduction for every $3 that you earn. So it gets a lot more lenient there. And then once you are past that full retirement age, then there's no limit. You can earn as much as you'd like and not have any reduction in your Social Security benefit. So obviously the earnings limit is a key factor to consider when you're between 62 and your full retirement age. And then that good news is that it does go away once you hit full retirement age. So there's a lot to think about and look into when talking about Social Security benefits. Last quarter, we did host another webinar that just focused on Social Security. There are quite a few caveats there that you need to be aware of when making the decision on when to pull the trigger on getting the benefits. So we're going to include a link to that in the email that we send out. So invite you, of course, to ask us any questions that you might have about it, but also feel free to refer back to that webinar. We had a specialist from the Social Security Administration join us on that call, and he had a lot of really good information and tips in there.
Yeah, he spent a full hour on just that Medicare. So did a far deeper dive, lots of side issues that aren't relevant for everybody, but might be relevant for some. Things like Social Security for divorced spouses. When you start thinking about it, there are a lot of different scenarios, and he did a far better job than we could do covering that. But that is out on the website. We'll be including that a link in our follow-up email.
That's right. And the Social Security Administration has other tools and resources too that you'll become more familiar with once you get closer to retirement age, and that's what some of this is. So what to bring when you apply for Social Security benefits. So we recommend, again, put some effort into making that decision well ahead of time, and don't delay in filing after you have made that decision. We typically recommend that you start the filing process 4 to 6 months prior to actually wanting that to turn on. So that's the basics of Social Security and how it's taxed there. Joe, now if you
Sure.
turn over you for section 4.
This is our fourth section. How much do you actually need? If you're years away from retirement, we'd like to suggest using rules of thumb. Some good rules of thumb is what is the national average. So if you looked at everybody in the country and how much is the typical person spending in retirement, they're spending about 75 to 80% of their pre-retirement income. That's relatively easy to calculate if you're going to retire tomorrow. If you made $100,000, 75% of that is $75,000. That's great if you're going to retire tomorrow. It gets more confusing, however, if you're years away from retirement, and that's where the math comes in. And we have that form that I told you that was such a mess to work with. That's what they try to walk you through. There's some online calculators that we'll show you in a second that give you an abbreviated version of this. The other thought would be or a rule of thumb, I guess, is if you can save 10% of your earnings your whole career from the time you start till the time you retire at about 65, you should be in pretty good shape. But starting out, if you're close to, if you're some years away, that 75 to 80% rule is good. The other thing is as you're getting closer, we recommend doing that far more detailed analysis of actually tracking your expenditures and then tracking the taxation on the various forms of income that you're going to get. So that is far more detailed. That's what we call this kind of more generic approach is goal planning. And in the financial industry, the other one is called cash flow planning. And that's where you take a look at your expenses and your revenue in much more detail and plan it out year by year. But this is a kind of a good generic way of estimating it if you're talking about years ahead. Alternatively, if you're getting ready to retire and you have a relatively simple situation, this may be hard for most people don't recognize this, but over half the people in the country do not pay any income tax. And you can make $50,000 or $60,000 as a married couple and not pay. It's not unusual at all for married couples to make $50,000 or $60,000 and not pay any income tax. If your lifestyle is such that you're expecting to spend more than that, or as your income grows, then your retirement plan becomes more complicated, and that too would tend to lend itself to wanting to go ahead and do the more detailed cash flow analysis that we'll talk about at the very end here. Now, earlier we said, well, let's take a look at that gap. We figured out that we used the example of needing $5,000 a month and getting $3,000 from Social Security, so you have a $2,000 gap. Where's that gap coming from? On a national basis, this shows you where retirement incomes is being funded. You can see that on a national basis, 37% of retiree income is coming from Social Security. Now, some folks continue to work. Steve talked about it, receiving Social Security while you're continuing to work. 28% of the people, 28% of the income of retired people is coming from their earnings. So they're still working, and that they're supporting themselves by taking Social Security and maintaining some employment. Other employees have, other retirees will have government pensions, My wife is a retired school teacher here in Missouri. School teachers do not receive Social Security in Missouri. Other public employees will receive Social Security and they'll have a pension as well. Firefighters, most police, most state employees here in Missouri, a lot of federal employees will have both Social Security and a government pension. Perhaps the biggest thing in the last 20 to 30 years that has happened in the pension market is the private pensions. Years ago, most major corporations had traditional pension plans that paid you a certain amount of money every month, and that was a mainstay of our country's retirement. However, because people are living longer, the impacts of inflation, the pressures on those pension plans grew and grew and grew. This is a kind of a startling number, but if 1900, if you were lucky enough to live to age 65, on average, your retirement would last 1 year. As you'll see in the next slide here, retirements today last 20, 25, 30 years. So the amount of money necessary for retirement has grown dramatically. And what used to be what they referred to as defined benefit plans, those were the old-fashioned pension plans where you would get a certain amount of money every month for the rest of your life. You didn't really have to make too many decisions then. The company you work for would hire actuaries. They would hire investment managers. You work for the same company 30 years, you retire, and then you get that income stream. That still works in the public sector. It has declined dramatically in the private sector. And those are being replaced with things like 401k plans. 401k plans, I think probably everybody is aware of those. Those are referred to as defined contribution plans. In other words, we know how much is being contributed to those, but we don't know what the benefit will be when you retire. And as a result of that, it's been great for the financial planning industry in the sense that so much of the decision making has shifted from the traditional pension plans to the individuals. And if you think about it, now you have to figure out how much you need to save. As you're saving it, how do you go ahead and invest it? And then when you retire, how do you go ahead and make it last the rest of your life? And that's what we're referring to here with this asset income. That is personal savings that are designed to go ahead and support you and augment that gap that we talked about earlier. And for each dollar in gap, you're going to need 20 to 25 times that amount. If you have more conservatively, 25 times would mean that you could take out 4% distribution with the hope that that would then grow with inflation. We know how people kind of like to see how they measure up to the rest of the world. Googled on Motley Fool, which is one of the internet's big financial websites. And in 2022, the average household income was $75,254. So that's the average. And that's going to be skewed high because you have some people who made a whole lot of money. The median income is perhaps something that you might want to know as well. The median means half the people made below that amount and half the people made above that amount. The median household income, and this is include married or single, so it doesn't break it out by that, was $47,620. And in 2022, the average Social Security benefit was $1,681. Just kind of some benchmarks. I think that's interesting to help you get some perspective on where you all might fit in. We said that retirements are lasting much longer. In this particular slide, they're just trying to demonstrate that as time goes by, inflation kicks in, and they have a house in Florida. If you wanted to buy a second home, well, you can see that by waiting 10 years, it's going to grow from $361,000 using kind of an average inflation over the last 20 or 30 years, grows to $485 over a 10-year period. If you're into camping and RV vehicles, that might grow from 73,000 up to 98,000 over a 10-year period. If you're into vacation and traveling, like that would potentially grow from $1,500 a head up to $2,000, and a round of golf might go from 75 to 100 over a 10-year period with kind of historic. So inflation is a big component and a big concern. We talked about longevity a little bit earlier. A 65-year-old man can expect to live to age 83. A 65-year-old female can expect to live to 86. Those are averages. Perhaps the biggest, fastest growing demographic in the country is people living over 100. So there's certainly, that's not the outliner that it used to be. And when they talk about inflation and retirement, one of the big things, probably the biggest concerns is the healthcare costs. And it's healthcare costs wreck more retirement plans than anything. According to the study cited here by Fidelity Consulting from 2022, a 65-year-old American couple retiring in 2022 will need $315,000 to pay for medical expenses throughout retirement, not including nursing home care coverage. Now, fortunately, when you turn 65, much of your medical costs are going to be covered by Medicare. Very important to note, people get this confused. Medicare is what you paid for. When we said earlier that you put in 7.65% for Social Security, actually 1.35% of that is specifically for Medicare. And so that is something that you bought by your years of work. And that is the insurance that kicks in when you're at age 65. Medicaid is insurance that's available for folks who aren't as fortunate. That is insurance for the indigent. So we're going to be talking about Medicare here, and we will bring up Medicaid again in a couple minutes. But there are 4 parts of Medicare, and I'm going to read these because I want to be succinct in my explanation. Part 1 is a hospital insurance, and Part A helps cover inpatient care in hospitals, inpatient rehabilitation facilities, and inpatient stays in skilled nursing facility. It also covers hospice care and some home health care and care services. You choose your hospitals and the facilities you want to use. So think of that as the insurance, more kind of like the buildings that you go to as opposed to the people you see. And they say that it provides skilled nursing facility care. It does, but it's very limited. And we'll circle back to that in a couple minutes. Part B is, reading again, Part B helps cover medically necessary services from physicians, outpatient care, and other preventative services. As in Part A, you select your doctors and other providers. So that's Part B. Part C is what they call Medicare Advantage plans. I can talk a little bit definitively about this because I've turned 65 a few months ago and have just gone through all this. Medicare Advantage plans involve private insurance companies and our HMOs, our PPOs that provide the hospital and medical insurance under Parts A and Part B. And most of these plans, you need to use the plan's doctors, hospitals, and other providers, or you pay more. So what they're trying to say there is your Part C kind of combines Part A and B, but you lose some of the flexibility. In my case, I've had a string of luck. I've lost 3 doctors in the last 10 years. I was without a doctor when I became eligible, so it was pretty easy for me. I ended up going into the Part C, and I have been very, very happy with it for the last few months. Part D is Part D would, if you are in Part C, it covers Part D, so you don't necessarily need to do this. If you are not in C, then you need to be A, B, and D. And Part D is your prescription drug coverage. If you want this coverage, you choose and join a Medicare prescription drug plan from private companies approved by Medicare. Most Medicare Advantage plans include some prescription drug coverage. And then if you're going the route where you do A, B, and D, then you you might want to go ahead and pick up a Medigap policy, because there's some deductibles and they call it donuts, and it gets pretty confusing, a little beyond today's scope, but that would be an additional premium. So you could conceivably have several different premiums, or you can have none. Well, I shouldn't say none. You're always going to have one. Let's talk about what those premiums might look like. Part A is free, so you don't have to, no one pays for Part A as long as they've been working long enough and paid enough into Medicare. And Part B, everybody pays for, and that is $164.90 in 2023. And if you recall earlier, I was telling you that there's all these little traps in the tax returns. As your income goes up, you can end up having to pay more money for your Part B coverage, and it peaks at $560.50 a month. So that's going to depend on if you're what your income is. So that's Part B. And in Part C, it's going to vary by plan. I've been very happy with it. I picked I picked the most inexpensive one. It's free. So all I do is I still have to pay the Part B, but it's going to the private insurance company instead. So I pay my Part B, and that's it. If you want to if you're going the A, B, and D, and C covers Part D for me, so I don't have to do that. Part D, if you're going the other route, so you're going to buy Part A, Part B, because you want to select your own doctors and hospitals. Then you very well may want to buy the prescription coverage, and again, that's going to vary by plan. A lot more decisions to make if you want to do A, B, and C. I mean A, B, and D. Excuse me, all these letters. And then if you want Medigap, that might be additional expense. Gosh, years ago, the Medigap coverages were all over the board. They're very confusing. Now they've standardized them. Here's a resource. If somebody goes that route, we have someone in our office, Drew, who works in this area and can help you as well. If you have somebody else, there's a number of property and casualty and health people that can help you on this. And then I want to wrap up this section before we go to the next one with long-term care insurance. We spoke earlier that the Part A coverage will provide some long-term care insurance. It is very limited. If there is anything that creates hardship for retirees and kind of breaks any plans of leaving money to your next generation, it would be long-term care insurance. The typical cost for long-term care insurance last year for 1 year was over $100,000 for 1 year. You can see how that could be devastating for families' finances. What happens is if you go into the nursing home, you are required to spend down your assets, and you are left with very, very little assets. And then when everything's gone, then you're qualified for Medicaid. Remember, Medicare was the insurance that you paid for while you were working. Medicaid is the insurance for the indigent. So, you end up in a Medicaid home, and all of your money's gone. They will leave very, very little money for you. There are some there's some exceptions for couples and spouses living in homes and everything, but it is absolutely devastating. One of the questions that Steve, hop in here if you want. We have difficulty giving guidance on this sometimes. If you are very wealthy, perhaps you don't need, you can self-insure. On the other hand, if you are you have nice savings but aren't overly wealthy, the cost of the insurance is a great deal. It can easily run $500 to $1,000 for a married couple per month. And the cost of the insurance is enough that it starts grinding into your assets. And while you're sitting there hoping to leave the assets to the next generation, you're spending them all in insurance premiums. So it's a difficult call to make, and something certainly worth considering.
Yeah, we found that there's really that Goldilocks zone there for people who have kids for, and risk tolerance we tend to think of when it comes to investing money in the stock or bond markets, but this is a little bit of a risk tolerance issue too, where if it's really important for someone that they leave behind a certain amount of money for their heirs, and they want to really be sure that there's nothing that's going to derail that, then that person that Joe just mentioned, who is in the Goldilocks zone of how much they have in assets, they're usually the clients that we found have just more of a desire to have that part of their plan secured through long-term care insurance.
This is a website. Again, this will be on the slides when we send them out to everybody after today's discussion. But if you're interested in long-term care, that's a resource for you. The next section is where we're supposed to fill out that ridiculous form that I was talking about earlier. If you're looking to if you're years away in particular, or you think your situation's fairly simple, I would strongly recommend using an online calculator. There are a variety of them out there. I'm going to show you an example on our website, one that is easy to use. These are not necessarily terribly accurate, but they are, you can play what if with them, relatively easy. If you have a 401k plan, and that 401k plan or any investment company is going to have one of these things available on their website. And they very well might be better than what we have in ours. There's a trade-off when you're doing these things. The ones that are easiest to use and most versatile are going to be the least accurate. The more accurate you get, which is this is what we referred to earlier as a goal-oriented type of planning process. It's very kind of generic and big picture. The more specific and detailed and complex your situation might be, that would dictate using more of a cash flow approach, which is far more detailed and far more accurate, but it requires a lot more work. This is a very easy one to use, these types. And I'm just going to go out to our website now. Am I share? Everybody see Steve, do you see my website?
Yep.
Yeah, okay, our website. So if we go out to our website, West End Advisory Group, you go into resources, you can scroll down, and we want to go to calculators. And we are running right now. We are 5 minutes over. We're going to wrap this up in 2 or 3 minutes. I'm going to make this very quick. You go into calculators. We want to scroll down to view all calculators, and then we want to do the saving for retirement. And to show you how simple these are, you enter in your current age. We'll just go ahead and play real quick. 55. Your current income, we'll just make it something simple, 75,000. Spouse's annual income, make that 50,000. You don't need to have a spouse. If you're a single person, you can just leave that in. If current retirement savings, we'll say that you have $200,000. Desired retirement age, 65. Years in retirement, 20. And then you just fill in how expected inflation rate, 3%. Income replacement ratio, in this case, we want to say 75%. You can change any of these, your pre-tax rate of return, your post-tax rate of return. Do you want to include Social Security? Yes. Are you single? Are you married? You're married. And then you calculate. And it will tell you, it'll give you a quick result of how much more you need to be saving on a monthly basis. It says here, based on the inputs you provided to provide the inflation adjusted income you desire, you may potentially need to save 19, almost 20%. So obviously this is for somebody who's hasn't done a very good job of saving, but you can go right back in then. This will give you your detailed results. It'll tell you how much your salary is. They'll show you all their homework right here. The beginning balance, and then each year, the growth, your retirement earnings and so forth. So that'll do it all right there. And then it'll provide you the ability to reset that amount. And you can change everything and it'll just take you, you can play what if, very simple. You don't have to go through all the calculations. The other alternative that's out there would be cash flow analysis. We happen to use eMoney, and I'm going to wrap this up in a minute or two. We happen to use eMoney, and I'll show you the difference between those. These are not a real client. We have some sample clients built in here now. And I'll get a fairly complex one. Don't get intimidated by we like complexity to demonstrate how flexible it is. But in this case, we are actually going ahead and building out year by year what's going on. So this would be a fairly high income couple. We're taking a look at their earnings for each year. Frank's earnings, in this case, Joanne's pension, Joanne's part-time job. We're plugging in their Social Security. We're taking a look detailed year by year what that cash flow is going to be. And likewise, we're taking a look year by year what their expenses are. And you can see here, they're paying off what their liabilities are. If we drill in, you can see we're just collecting all of this stuff. We have them paying off a credit card balance this year, and then we have them paying off their mortgage in a couple years. And it's tracking all of this stuff. And in the background, it's also calculating the taxes on their various forms of income, and then tracking that as we go along. You'd start seeing it's a far more detailed analysis, but it requires far more inputs, and but it will give you a far more accurate result. Two different ways of doing it, and a lot of it will depend upon what your time horizon is or your complexity of your situation. We have now started, I think, at about 6:32, and we ran at 1 hour and 8 minutes. I think we are done, unless there's any other questions as we wrap up. If there aren't any questions, Laurie, do you want to close this out?
Sure. That concludes our presentation. A recording of today's webinar will be emailed to all those who attended, and thanks and have a great evening.
Thank you all.
Thank you.